Today I'm going to talk about the loved and hated financial metric called EBITDA. I'll show you why it's used in analyses for buying and selling businesses, and if you stay to the end, I'll tell you how EBITDA can totally screw over beginners when they analyze their own deals. My name is Troy Massey. I'm a certified management accountant. I have an MBA and nearly 15 years of professional finance experience helping to grow companies mainly in venture capital and private equity environments, which just means that I have spent way too much time looking at spreadsheets. So let's get to it. In financial analysis, there are a lot of financial measures that aim to help you understand how profitable a company is. And one of the most common ones people know about is net profit. That's the last line on a company's income statement and tells you if the company is profitable after subtracting all of its expenses from its income. Well, EBITDA is also a measure of a company's profitability, but it's magical. It's magical because it takes interest expense, taxes, depreciation, and amortization, all things that are included in the net income metric, and says, what if we calculate the profit as if they didn't exist? And that's why EBITDA stands for earnings or profit before you factor in interest, taxes, depreciation, and amortization, because again, in EBITDA land, they don't exist. Okay, so the calculation of EBITDA is straightforward. Take net profit and add back to it interest, taxes, depreciation, and amortization. But why is it used in the world of M&A rather than net profit? If you're working, say, in private equity, you tend to analyze a lot of companies, much more than your firm ends up actually purchasing. EBITDA is a go-to tool among investment analysts because it makes a direct comparison of these companies' profits from operations clearer than if you were to use net profit to do that comparison. That's because interest expenses, taxes, depreciation, and amortization, the items EBITDA takes out of the analysis, often don't reflect the financial performance of a business's core operations. They are more about how the company is financed, its tax strategy, and accounting practices. And not only can these expense items carved out of EBITDA confuse a comparative analysis of companies, it's actually the case that these expense items can change drastically under new ownership after an acquisition. Let me give you an example of the change I'm talking about. Let's start with interest expense. Interest expense exists when a company uses debt to finance its business needs. Here's a really simple example. Imagine you are interested in buying a car from a guy who hasn't fully paid off his car loan. His monthly payment is $1,000, of which $900 goes to pay off the principal of the car, and $100 is the interest expense that goes to the bank that initially loaned him the money to make the purchase. Now, when you are looking to buy this car, do you care about how much interest the seller is paying to his bank? No. What you care about is understanding the current value of the car and hopefully getting the seller to agree to a good deal. If you agree to a price of $10,000 and take $10,000 out of your bank to pay the seller, then you won't have any interest expense at all. Alternatively, if you have to borrow the entire $10,000 at a stupidly high interest rate of 25%, then you might be paying more interest than the seller was. Either way, what the seller is paying in interest expense is information not relevant to you because his interest expense was determined by the way he financed his purchase, and your interest expense will be determined by how you finance your purchase. The same is true with business acquisitions. When acquiring a company, the focus is on the company's operational value, like the car in our example. Just as you don't base your car purchase on the seller's loan terms, in an acquisition, the buyer doesn't base their decision on the seller's interest expense. The buyer will likely finance the acquisition based on current market conditions, and that will determine their interest expense. For that reason, EBITDA removes interest expense from the equation. Hey, thanks so much for watching. If you're liking this video, I would really appreciate you giving it a like and subscribing to the channel. Thank you, and let's get back to it. Now, let's talk about why EBITDA excludes taxes. This comes back to the idea of comparability. So say our PE firm focuses on lemonade stands. We will look at a bunch of lemonade stands, and it will happen to be the case that some of the lemonade stands will operate in more favorable tax jurisdictions, while other stands will operate in California. The worst. But again, what we want to understand as we start comparing all these lemonade stands is how profitable they are from their core operations. Looking at after-tax profit makes it difficult to directly compare all of the stands. Stands in California will appear less able to generate profits simply because they operate in a godforsaken tax wasteland. Conversely, it's also possible that companies that are carrying forward prior year losses may appear to be more profitable simply because those losses reduce their current tax liability. By squeezing out the tax impact altogether from our analysis, we get rid of this noise, and our comparison of the lemonade stands becomes more apples to apples, or should I say, lemons to lemons. Moving on to depreciation and amortization. First off, if you don't know what these things are, they are accounting methods that spread the cost of a long-term asset over the life of that asset. So if a company buys a company's Cybertruck for $100,000, awesome, and expects to use it for 10 years, rather than showing all $100,000 as an expense when they purchased it, they would spread the $100,000 expense over 10 years or recognize $10,000 per year. It's called depreciation when you do this for tangible assets like vehicles, and it's called amortization when you do this for intangible assets like patents. Now, why does EBITDA exclude depreciation and amortization? Again, because factoring these into an analysis can distract from comparability. Say our PE firm is now moving on up to buy laundromats. We've narrowed it down to 2 laundromats, one new one and one old one. The new one has just purchased all of its laundry machines and therefore has depreciation expense hitting the income statement each month and lowering net profit. On the other hand, the older laundromat has already recognized the depreciation of its machines and therefore has no current depreciation expense. If we look at net profit, the newer laundromat can appear less profitable simply because of the depreciation. Another reason depreciation can confuse a profitability analysis is because depreciation policies can differ from company to company. For example, let's say we are looking at 2 laundromats who bought their machines on the same day and started operations on the same day. They both have the same revenues and costs, the only difference being that Laundromat A has a policy to depreciate their machines over 5 years, while Laundromat B has a policy to depreciate their machines over 7 years. If we do a profitability analysis using net profit, Laundromat A will appear less profitable simply because it chose to recognize the machine's depreciation expense over a shorter period of time. Again, we are interested in how profitable the daily operations of the business are, and excluding depreciation and amortization from the analysis helps us to focus on just that. All right, now hopefully why to use EBITDA is making sense, but EBITDA comes with a trap. Lots of amateur investors or first-time business buyers tend to equate EBITDA with cash flow that they as an owner will get to keep. They go on bizbuysell.com or whatever business broker they use and get real excited about a business with $500,000 in EBITDA. They figure they can afford to bring on an operator and then sit back and collect a multiple 6-figure salary as an absentee owner. Well, here's the problem. EBITDA does not equal cash flow. Or to put it more clearly, EBITDA does not equal cash flow. Let's break this down. Interest expense. EBITDA takes it out because, as we discussed, the seller's interest expense is irrelevant to you as the buyer. But you have to put it back in when trying to understand what post-acquisition cash flow will look like. The vast majority of deals involve some type of loan, whether that be an SBA loan or seller financing, which should be part of every deal. Making sure that your cash flow can cover your loan repayment and interest, what's referred to as debt service, is a critical analysis to do. Next up is taxes. Unless you have the best tax strategist in the world, you're going to pay taxes. So that dreamy EBITDA number in your mind has to be reduced by the cash that you will end up forking over to Uncle Sam. Now, let's talk about depreciation and amortization. From our discussion earlier, we know that depreciation and amortization are not cash expenses. In that sense, carving these items out does actually help us better estimate the day-to-day cash flow. However, the mistake beginners make with this is forgetting that these big assets need to be replaced. Warren Buffett is a well-known critic of the EBITDA metric and famously said, "Does management think that the tooth fairy pays for capital expenditures?" Think about our old laundromat example from earlier. All of the machines in this laundromat were fully depreciated. What does that mean? It means that the machines are older than what management thought their useful life would be. That means if you buy the business, you should be prepared for a scenario where you are the one to pay for the replacement of machines as they start to break down. This is Buffett's point. Capital expenditures are those items that are allowed to be depreciated, and they typically constitute big cash outlays. So excluding depreciation and amortization from a profitability analysis may help us better understand cash flow from operations, but it does not account for the big capital expenditures that will also require forking out cash to continue to operate the business. In the end, experienced analysts understand that EBITDA is just one of many metrics that should be used when assessing whether to buy a certain business. It is the novices who rely too heavily on EBITDA and open themselves up to financial trouble post-acquisition because of it. If you found this content helpful, please subscribe to the channel. And if you're interested in acquiring a business, let me know and I'll tee up some acquisition content that will be helpful. We'll see you next time.